This is the second in a series of pre-lecture videos on exchange rates for the course Global Business Economics. I'm David Frankel, a professor at Melbourne Business School. Before watching this video, you should watch the prior video in the series, which is called Exchange Rate Concepts. Let's begin. In the prior video in this series, we learned about three types of exchange rates. The nominal exchange rate between the Australian dollar, or AUD, and the US dollar, or USD, equals the number of US dollars that you can purchase in return for 1 Australian dollar. The real exchange rate equals the cost of a fixed market basket in Australia in US dollars divided by the cost of the same basket in the United States in US dollars. The purchasing power parity, or PPP exchange rate, equals the cost of the US market basket in US dollars divided by the cost of the Australia market basket in Australian dollars. In the preceding video in this series, we also derived a key equation, that the nominal exchange rate equals the product of the real exchange rate and the PPP exchange rate. We will now turn to the key question of this video, which is, how is the nominal exchange rate E determined? Broadly speaking, there are four theories. But first, we will need some notation. The dagger symbol will refer to our equation from the prior slide, which states that the nominal exchange rate is the product of the real exchange rate and the PPP exchange rate. Moreover, SR will refer to the short run, LR to the long run, CB to a central bank such as the RBA, and AUD to the Australian dollar. Furthermore, we are going to focus on normal times in which inflation is low and unemployment is not a problem, so that there is no need to raise or lower interest rates. Since the RBA is keeping inflation low, the prices of goods and services in Australia cannot change very much in Australian dollars. And as the RBA is holding the line on domestic interest rates, the prices of Australian bonds in Australian dollars also cannot change much, as these prices are determined mainly by interest rates. Our first theory is called the PPP theory of exchange rate determination. It is based on an important economic principle, that large differences in the price of a given good across countries cannot persist in the long run. This assumes the prices have been converted to a common currency, such as US dollars. The argument is as follows. Suppose the price in US dollars of iPhones in Australia is much higher than the price in US dollars of iPhones in the United States, and that this difference is expected to persist for a long time. What will happen? Well, enterprising firms will start buying the cheaper iPhones in the US and shipping them to Australia, where the price is higher. This process raises supply in Australia, shifting the Australian supply curve to the right. It also reduces supply in the US, shifting the US supply curve to the left. These supply curve shifts have the effect of lowering the prices of iPhones in Australia and raising their price in the United States. This process continues until the prices become equal, so that exporting iPhones from Australia to the US is no longer profitable. Hence, international trade will tend to prevent the emergence of large, persistent price differences of particular goods across countries. But if every good has the same price in US dollars in the two countries, so does any given basket of goods. Accordingly, the real exchange rate, which is just the ratio of the US dollar cost of a fixed basket of goods in Australia to the US dollar cost of the same basket in the United States, must equal 1. Now recall that the key equation from the prior pre-lecture video states that the nominal exchange rate equals the product of the real and PPP exchange rates. If the real exchange rate equals 1, this equation implies that the nominal exchange rate equals the PPP exchange rate. This theory, that the nominal exchange rate must converge to the PPP exchange rate in the long run, is called the PPP theory of exchange rate determination, or the PPP theory for short. An important implication of the PPP theory is that a country that has a persistently high inflation rate relative to other countries must eventually see its currency fall in value. To see why, recall that ePPP is defined as the ratio of the US basket price in US dollars to the Australian basket price in Australian dollars. Now suppose that inflation is persistently higher in Australia than in the United States. Over time, the ratio will tend to fall. Thus, by the PPP theory, the nominal exchange rate EAUD-USD will also tend to fall. In other words, the Australian dollar falls in value or depreciates relative to the US dollar. The PPP theory is summarized on the first line of the table. International trade implies that the real exchange rate will stay close to 1. Thus, the nominal exchange rate will remain close to the PPP exchange rate by the equation marked with a dagger symbol. This implies that persistently high inflation in Australia will cause the Australian dollar gradually to fall in value or depreciate relative to the currencies of low inflation countries. We now turn to the second theory, which is called demand for goods. We'll work with a concrete example, a rise in world demand for Australian coal. This leads Australian mining companies to hire more workers. But this in turn means that there are fewer workers available to make the Australian export brands that the world knows and loves: Billabong, Foster's, Arnott's, Bellamy's Organic, A2 Milk, and so on. Accordingly, the prices of these other goods must rise on the world market. That is, the cost of the Australian basket in US dollars rises relative to the cost of the US basket in US dollars. This amounts to a rise in Australia's real exchange rate with the US. But we are assuming that the RBA will keep inflation low. Thus, the cost of the Australian basket in Australian dollars cannot change much. Yet, we just said that the Australian basket cost in US dollars must rise. The only way that a basket's cost in US dollars can rise while its cost in Australian dollars stays the same is if one Australian dollar buys more US dollars than before. That is, Australia's nominal exchange rate E with the US dollar must rise. These conclusions now appear on line 2 of the table. A rise in world demand for a country's goods leads E real to rise, which raises E by the dagger equation and the fact that ePPP cannot change much. For instance, a rise in world demand for Australian coal leads the Australian dollar to appreciate. The third theory is demand for assets. Here, the idea is that anything that makes Australian assets more appealing relative to US assets must lead to an immediate appreciation of the Australian dollar relative to the US dollar, coupled with an eventual reversal of this appreciation. The reason is that the subsequent reversal will create a capital loss for holders of Australian assets. The anticipation of this capital loss offsets whatever happened to make the Australian assets more appealing, so that investors are once again willing to hold both Australian and US assets in their portfolios. There are 4 key events that can make Australian assets more appealing relative to US assets. The first is a rise in the Australian interest rate relative to the US interest rate. The second is a rise in the US default risk relative to the Australian default risk. The third event is the imposition of restrictions on foreign asset ownership by Australian households. While this is unlikely to occur in Australia, it is a regular occurrence in other countries such as China. The fourth event is a liberalization that makes it easier for foreign companies to invest in Australia. Any of these 4 events would raise demand for Australian assets relative to the US assets, thus causing the Australian dollar to rise temporarily against the US dollar. The fourth and final theory of exchange rate determination is changes in the supply of assets. Here the story is that a fall in the supply of Australian assets relative to US assets leads to an immediate rise in the Australian dollar coupled with a long-term fall. The intuition is that in order to entice investors to hold more U.S. assets and fewer Australian assets in their portfolios, the expected return on Australian assets must fall relative to that of U.S. assets. And since the central banks of Australia and the U.S. are holding interest rates fixed, these changes in expected returns must occur through changes in capital gains. That is, investors must expect that the Australian assets will fall in value over time relative to the U.S. assets. This is accomplished via an immediate rise in the value of the Australian dollar vis-a-vis the US dollar, coupled with a long-term decline in this value. In this way, the future depreciation of the Australian dollar will create a capital loss. The anticipation of this loss induces investors to shift their holdings from Australian assets to US assets, as is required to clear the market. Typically, such changes in the supply of assets are the deliberate result of central bank interventions. For instance, if the RBA wants to raise the value of the Australian dollar, it can trade US government bonds for Australian government bonds. Imagine what would happen, however, if a large hedge fund, knowing that the Australian dollar is only temporarily high, sells Australian dollars short on the spot market. Enough selling pressure might hasten the inevitable devaluation. If so, the hedge fund could make a killing by buying the Australian dollars back at a sharply lower price. This is known as a speculative attack. The threat of such attacks limits the ability of central banks to manipulate their exchange rates by trading assets. This concludes the first GBE pre-lecture video on exchange rate determination. Thank you for watching.